We don't need more digital currency. We already have digital currency. It's called the US dollar. It's
Mention them because unlike the banks, these crypto assets all seem to be scams, and I want you out of them. Many of you traffic in them every day. You should. You're wrong.
The Securities and Exchange Commission filed separate civil lawsuits against two major exchanges, Binance and Coinbase.
This makes this asset class radioactive waste. We are not going to touch this until this thing's resolved.
So we think that something like that, which is, purporting to be money, would need to be appropriately regulated.
Today, we find ourselves at a pivotal moment in the world of cryptocurrency. The future of crypto is hanging in the balance as it stands at a crossroads of innovation and US regulation. In this video, let's talk about the real problems crypto is facing against the SEC, what its future outlook is going forward here in the United States, and most importantly, how all of this impacts you and your crypto investments. But before we talk about what's happening today, let's go back to understand the history of cryptocurrency and why it's so important to what's happening today. Did you know the first cryptocurrency was actually created in 1995 and was called eCash? The cryptographic electronic micropayment system was used in just one bank in the United States. It required user software in order to withdraw notes from a bank and designate specific encrypted keys before it can be sent to a recipient. This allowed the digital currency to be untraceable to a third party. Heard of the internet, and before most homes had personal computers, David Choum was very passionate about the concerns for the future of online privacy, calling cyberspace antithetical to the basic principle underlying the mechanisms of democracy. Powerful words, but I think we can all agree with him that online privacy is still questionable at best. But it was the power of the technology that impressed him the most. Of its potential, he said, you can pay for access to a database, buy software or a newsletter by email, play a computer game over the net, receive $5 owed to you by a friend, or just order a pizza. Ladies and gentlemen, I'm here to tell you that dreams do come true, because some 25 years later, someone actually used a crypto technology to buy pizza, 2 large pizzas in fact, for 10,000 Bitcoin. That better have been the best damn pizza they've ever had, because at its highest point, 10,000 Bitcoin was actually worth $687 million. Even Elon wouldn't spend that much on pizza. The rise of cryptocurrency came hard and fast around the world. In fact, new crypto owners kept the same pace with new internet users over the last decade. And as the years went on, more and more of the biggest brands in the world adapted some form of cryptocurrency for payment. Word spread like wildfire of this new can't-miss technology, and it was led by its grand champion, Bitcoin. In February 2011, Bitcoin reached its first milestone by crossing $1 and shot up to its next milestone, crossing $1,000 at the end of 2013. But as the notoriety was rising, so were the concerns around the world by those that felt like they needed to control it. China banned their banks from using Bitcoin over concerns of its black market usage. Bolivia came out and said it is illegal to use any currency that is not issued and controlled by a government or an authorized entity. And Bangladesh took a step further and said Bitcoin is not a legal tender of any country. Any transaction through Bitcoin or any other cryptocurrency is a punishable offense. While other countries were left scrambling, trying to figure out how to classify Bitcoin and whether or not it fit into their already existing rules. Is it an asset, a currency, a commodity, a hoax? It's an important distinction that'll come up later on in the video, but for now, let me know down in the comments how you personally classify Bitcoin and other cryptocurrencies. The modern day crypto collapse started with FTX in November of last year. FTX quickly rose to international prominence through a series of high-profile acquisitions, aggressive marketing strategies with high-end influencers, and low trading fees. Even those unfamiliar with the technology were attracted to FTX with promises that they could park their money in accounts and gain higher yields than traditional banks. Major venture capital groups also bought in, investing almost $2 billion in the company. As the price of Bitcoin, which is generally seen as an indicator to broader crypto markets, dramatically declined from its 2021 highs, other crypto and token values followed suit. The broader crypto industry decline had already seen other platforms shut down, but FTX seemed immune and even bought some of its struggling competitors. However, after FTX's balance sheet was leaked, exposing some potentially fraudulent business activities, some of the largest holders withdrew their assets from the platform, which created a chain reaction. The FTX collapse was foreshadowing to what would happen to the banking crisis a couple months later. Bad balance sheet that led to customers wanting to withdraw more money than the institution had available, leading to a liquidity crisis and eventually a complete failure. Which brings us to today's events. The Securities and Exchange Commission, or SEC, unveiled a barrage of charges against two of the world's largest crypto exchanges, Coinbase and Binance, kicking off a legal battle that will help define the future of cryptocurrencies. Although these two lawsuits are different in many ways, Coinbase and Binance are being accused of failing to report their exchanges with the SEC. But at the core, the entire reason why crypto exists is to operate outside of the traditional financial system. And this is where a lot of the gray area lies. Most of the current finance rules are created before the cryptocurrencies even existed. What many crypto companies want is new rules of the road that are crypto specific, but the SEC couldn't care less. SEC Chair Gary Gensler has made it very clear where he stands on this crypto debate. In the past, he's been quoted as saying, "We don't need more digital currency. We already have digital currency. It's called the US dollar." Or my personal favorite, when he compared the current crypto market to the 1920s right before the Great Depression, saying it's full of hucksters, fraudsters, and Ponzi schemes. If you like these news-related videos in the personal finance space and want to see more of them, make sure to subscribe to the channel. This all brings me back to the point of what is cryptocurrency and how should it be classified? For now, this is up to the courts to decide. But one thing's for sure is that cryptocurrency isn't going anywhere. Here's why. The SEC sued the largest crypto platforms on June 6th. The day before, June 5th, Bitcoin's value was $25,750. And by the end of the week, June 9th, Bitcoin's value had gone up $26,500. Ordinarily, a regulatory onslaught by the oh-so-mighty US government would send asset prices tanking. That just didn't happen here. Bitcoin and other cryptocurrencies appear to have already shaken off the SEC's legal action. Whatever Gensler decides to do to the US crypto market, including possibly burning it to the ground, the industry is flourishing all across the world. While tougher US regulations feel appropriate given recent scandals, an SEC's scorched earth approach bad for American innovation. With that said, I have 3 ways the crypto industry and the SEC can both come out on top as winners. First, recognize crypto as a different asset class. The older rules were set up for old economy assets. Recognize crypto as a different asset class and set new regulations, guidance, and clarification to help innovation and invention thrive. Second is to consider the sandbox approach. Basically, this approach is defined as testing innovation like fintech and blockchain products with limited or minimal restrictions. This model fuels innovation while guiding future regulation, striking a balance between growth and stability. Finally, develop a transparent set of rules. Rather than interpreting the law on a case-by-case basis, US authorities should realize that having a transparent set of rules is the best way to support blockchain innovation while also protecting against bad actors. Even with all the negative press out there, my personal opinion is I don't think cryptocurrency is going anywhere. But with the tremendous uncertainty in the market, I would continue to proceed with caution. The current lawsuits could take months or even years to conclude. So with the 2 largest crypto platforms tied up in the battle, US crypto investors could have limited options. One way or another, I don't see how crypto is going to be able to operate in the same capacity here in the United States. Its ranges are going to be anywhere from limited regulations to being completely banned here in the US as companies move overseas to innovate. The United States and the SEC can't get too stubborn here either. Falling behind in a technology that truly has the potential to change the way how the world operates can be damaging years and decades down the line. As the crypto market has plateaued a little bit, another market has taken its place: artificial intelligence, specifically ChatGPT. What if I told you there was actually a way to invest using ChatGPT today? That's right, and I go over all the details in this video here.